You've worked hard to build a dream retirement. Now it's time to put that plan into action. This is Retire ATL with Aaron Vincent and Matt Decker. The team at Vincent Financial wants to help you build, protect, and grow income to get you to and through retirement. Now, Retire ATL with Aaron Vincent and Matt Decker.
This is the Retire ATL podcast, all powered by the Vincent Financial Group. You can get more when you visit retireatlradio.com. Thanks for subscribing. Thanks for downloading. Now, let's get to the show.
My name is Mark Owens. Gentlemen, when it comes to building retirement plans, hundreds of thousands of investment options. One thing that I love that y'all say all the time, everybody's plan is different. You don't walk into the Vincent Financial Group and say, give me retirement strategy B and supersize it. It doesn't work like that. But how do you make it work? How do you make it all make sense when putting a retirement strategy together?
Well, we got to talk about general terms. We got to get everybody on the same page. Most people they get overwhelmed by the thousands of options that are out there. I mean, shoot, there's hundreds of options just on like life insurance companies that you could choose from, or there's probably 1,000 options on annuity companies. Then you start talking about mutual funds and ETFs and bond funds, and you're
international and domestic, and
you're drowning. Yeah, you're drowning, and people are throwing you stuff. So it just doesn't work. So we got to get on the same page, and so we like to break it down conceptually and just say, no matter how we build this retirement portfolio, we want to make sure that you're armed with the right information and education so that you can make a good decision with your own money. And so we got to talk about the three kind of key characteristics of every type of investment. Doesn't matter if we're talking about stocks or bonds, mutual funds, real estate, oil and gas, annuities, life insurance, like none of that matters. They all are going to fall under these three key pillars. And so the three key pillars would be, and we'll go through these. Every single investment is made up of its ability to grow, like what's the growth characteristics of this investment, the safety characteristics of this particular investment, and then like how liquid is it? So those are the three kind of pillars: growth, safety, and liquidity. And the idea is with all investment vehicles, you get to choose two of those three components to kind of excel in. You don't get all three. There's not really a vehicle out there that's going to be 100% liquid, give you all the growth that you could ever want, and be as safe as possible. Like that investment doesn't exist. It's kind of like when they rolled out the healthcare several years ago. Mm-hmm. I forget, what did they say? That you could have really good quality healthcare. You could have timely, like it could be timely, short wait times. And then like how expensive is it? It could be cheap. So you can pick two of those three. It can be cheap and quick, but not good. Mm-hmm. Or it can be cheap and good, but not quick. Or it can be quick and good, but not cheap. I think that I just get, did I hit all those? Mm-hmm. Okay. So you get two of the three. That's almost exactly how investment portfolios work. You can get two of these three characteristics: growth, safety, and liquidity, but you can't get all three. And so then the question becomes, how do you get all three? You got to have more than one vehicle that you're using to kind of check all those different boxes.
I want the stock that grows a lot, that I can always, sell it and get my liquidity out. And also it's never going to go down in value.
Me too.
Yeah, me too. You can't do that in a stock.
No.
But you can have different investment vehicles in your portfolio. Each of those can do one or two of these three things. And then your portfolio can have all three of them, but you're not going to get it in a portfolio of just stocks, or you're not going to get it in a bond portfolio, or you're not going to get it with just an annuity, for example. But all of a sudden you kind of collect these things and do enough planning and analysis and research to know what the best combination for you is, your personal situation. Mark, you first started off by saying we don't have a cookie cutter kind of one or two or three sizes fits all. Literally every one of the families that we serve has their own kind of tailor-made portfolio. And so what is the right blend for you? Well, this is what Matt's saying. Get on the same page first. Mm-hmm. We've got to identify some things first. And now, or then once we've got that kind of understanding of what you're after and your comfortability with risk and your timing and your lifestyle and your desire to either spend all of your money or give to like philanthropic or to your next generation in your family or whatever it might be. Everyone's different. Once we know that about you, building that portfolio is easy because of these three realities.
And you get to play a part in it, right? It's not just us telling you what you need to do. We will make a recommendation. But once you understand kind of these three key characteristics of all the different investments that are out there, and then you get to look at your portfolio, you're like, oh, okay, well, I can see that I am heavy on growth and liquidity, but I have little to no safety. Well, that's good to know. And that informs maybe how you should be moving forward. Hey, if I'm going to build a really good, Aaron talks all the time about building durable portfolios. If I'm going to have a durable portfolio that's going to allow me to withstand the ups and the downs, it's going to keep me in a relatively healthy emotional zone, right? It's not like too hot where I'm freaking out, and it's not so boring that I'm like, what am I even doing? Right in the middle there. You're going to have each one of these in order to feel good about the growth, in order to have access to your dollars, and to not freak out when the market starts dropping.
We had some of our clients in here just recently, and they're getting to the point where they're about to retire, like pull the trigger once and for all. They've been kind of dancing with it. We've been managing their portfolio, kind of getting to this point, and they're about to actually pull the trigger. And we were talking, and if they're listening to this, you know who you are, and we love you. But the reality is the wife was describing that she wanted to buy a car before she retired. She wanted to get that expense out of the way first and get that car. And then she was explaining to me the level of research and analysis and comparison that she was doing on this car purchase. And she wanted a big enough car with grandkids, but she wanted good gas mileage, and she wanted, this kind of car with these certain luxury kind of options, but she didn't want to, the cost was, part of the issue. And like the point of this story is, she had put, and this is not uncommon, way more thought and way more analysis and conversation and Google research into all of the pros and cons, the different aspects of what car she wanted, way more research into that than on her retirement portfolio.
Right.
And I think that's just such a common reality that we find is that, and I don't know if it's because it's intimidating. And once you begin to have the conversation about your retirement portfolio, the depth and the layers, and you just kind of throw your hands in the air and say, I could shop a car, but I can't shop a retirement portfolio. I'm here to tell you that is why we exist. Like some people, very few people actually enjoy it, even less enjoy it and can do it well. That's why we're here. So if you just want to have that conversation about what are my options, where am I at now? I love researching the car I'm going to buy. I hate researching my retirement portfolio. It's what we do.
Yeah, we'd love for you to call. We got people standing by. This is a conversation that we have every single week. It's part of our second opinion service. And pretty much everybody that goes through it leaves. In fact, I would say everyone that has gone through it this year, the last 2 years, in recent memory, I can't think of a single person who left saying that wasn't worth my time.
Yeah.
Everybody leaves saying like, hey, guys, this was great. Thank you. I understand things so much better. Most people leave clients. And that's a pretty cool thing. So yeah, definitely call us 770-741-0120. We'll walk you through that process. It might be helpful. I was thinking, Aaron, maybe we should give some examples, like some examples of, the 3 key pillars, liquidity, growth, and safety, and what type of investments check those particular boxes, just so people can get comfortable with the idea of maybe what they already have in their portfolio and maybe also what they're missing.
Yeah, absolutely.
You want to start with like the common stuff, stocks, bonds,
sure.
ETFs.
Let's just take stock, for example. So a stock is something where you can buy and sell them on the exchange every single day.
And you know what you're going to get for it.
Yeah.
There's no questions there.
Long waiting period, no application, we're going to have to quote, or get a quote from the bank on what interest. No. It's you buy it and you can sell it on any day that the stock market is open. And so the point is it's very liquid. You have some money, you want it to grow, you buy a stock. Oh, you need some money, you need to sell that stock to get some money, you can sell it. It's very liquid. That's the point of liquidity. And just while we're on the topic of stocks, generally speaking, stocks are one of the best growth models as well. If you want to grow a portfolio, we talked about how these 3 kind of characteristics of every investment are true for everything, whether it's stocks or it's real estate, and it's no secret that the 2 biggest ways that wealth has been built in America in the past, 100 years, the stock market and real estate. Yeah. And so obviously pros and cons to both of those. But yeah, so Matt mentioned you can have 2 of the 3, but never going to get all 3. So a stock is a great example of you've got growth opportunity and you've also got liquidity. So that's 2 of the 3. If anyone knows, please call us, of the stock that the value can't go backwards. You can't lose money in it. The growth is really high and it's liquid. You can sell it whenever you want. I got to know about this one.
Yeah, I do too.
It's rhetorical because that doesn't exist.
Please give us a call, 770-741-0120. Let us know what that ticker symbol is, and we'll make sure that we tell all of you about it as well. You did a great job there, Aaron, on stocks, and I love how you threw out real estate as well, because that's if you're trying to check all the boxes, and you don't mind being a landlord, let's just say.
Yeah.
If you have stocks, you've got the growth and the liquidity boxes checked, and the one that you're missing would be safety. Well, real estate, in our minds, that's going to check the growth box. Real estate has been a crazy growth vehicle for so many people, but it's not liquid.
Mm-mm.
It's not liquid. Now, you can get creative, and someone might call our number and say like, well, I got a HELOC, so it is liquid. Okay, fine. Like you're skirting the actual issue. All right, let's just talk about the investment itself.
Part, yeah.
It's not liquid. You have to use a broker. It sits on the market, and you can't just tap into those resources whenever you want. But it is safe. It's definitely safe over the long run. Now, there may be periods where it's not as safe as it has been, but generally speaking, a real estate investment is going to be pretty safe as it relates to holding its value. It's more than likely going to hold its value and beat inflation. So if you've got a portfolio and you come to us and you're like, hey, here's my plan. Number one, I love being a landlord, so I own real estate. And number two, I have stocks for my liquidity and my growth bucket. It's like, yeah, you've got a pretty well-balanced portfolio there that covers the three areas: growth, liquidity, and safety. Does that mean that you should own stocks and real estate and just call it done? No, that's not what we're saying. But just trying to outline how these different investment vehicles work. So what about bonds in your mind, Aaron?
Yeah, so bonds, I'm glad you brought that up because this is one that will probably raise some eyebrows, or at the very least, people are going to be saying, wait a second, I didn't think that was the case. Bonds, for the longest time, like if we were at one of our educational seminars and I said, hey, we're having this conversation, I'm going to say, okay, raise your hand if you think bonds fit in the growth category. And no one's going to raise their hand on that because everyone, kind of sees bonds as, and if I said, okay, and raise your hand if you think bonds fit in the safety category. Every hand goes up. Every hand goes up. Well, and they aren't unintelligent people. It's just that what we've been told for a long time is that bonds are the perfect balance to stocks, because if the stocks are growth and the stocks are liquid, the bonds can be the safe. But unfortunately, that's not true. 2022, recent memory, for example, the most common bond fund in the world was down 13% or so, maybe even a little bit more than that in 2022, during the same year where the equities were down. So if you are retired, you're withdrawing income from your portfolio, and you've got stocks and you've got bonds, and you're thinking that I've got both my growth and my safety, I'm good to go. And then 2022 happens, and both sides of your portfolio, the growth and the safe, are both down, 13+% on both sides of the equation. Now what do? Well, you're in trouble because now you're forced to sell at a loss for the liquidity that you need to pay your bills because you're retired. And so, long answer to your question, Matt, I'm not saying that I hate bonds and no one should ever own a bond. I mean, it's not like they're useless, but to hinge the safe part of your portfolio on your bond allocation, I think is a major mistake. And it's been proven that way many times.
Can we take it one step further just to provide the context? The main reason that we would say you may not want bonds to be the thing that checks your safety bucket. The reason that I would say that is bonds are inversely, negatively correlated with interest rates. And so what that means is as interest rates fall, bond values go up, your bond fund values go up. And as interest rates rise, your bond fund value goes down. And so, quick story that I tell in most of our educational events that we do across the Atlanta metro area. Years ago, I saw my parents, it was like their truth in lending statement. Now, this was from like 1984, maybe. So it was one page. Now they're like 100 pages. But it was a one pager on the first mortgage that they had. They bought a house for, $100,000, and their interest rate was 14.5%. 14.5% interest rate on their 30-year mortgage back in the mid-'80s. Now, since then, what has happened to interest rates? It's been a straight line down from where they were at the peak there in the mid to late 80s to where they are now, a straight line down. If bonds are negatively correlated to interest rates, meaning when interest rates fall, bond values go up, that means that for the last 30, 40 years, bonds have been the easiest no-brainer play on the board for safety and growth because interest rates have been falling, straight line down, bond prices go up, and you get your yield. We are not in that environment anymore.
Right.
I mean, interest rates, we've seen them bottom out. They're about as low as they've ever been. over the last 5+ years. And now the risk is actually on the opposite end of the spectrum. The risk now is that interest rates rise or normalize. That's probably the better way to say it.
Yep.
Thinking about interest rates going up, people are like, that's crazy. I'm here to tell you interest rates going up would actually be normalizing interest rates.
Yep.
We're in an artificially low period. Them going up would be normal. That would be totally on par with what we should expect. And if that were to happen, not only are your bonds not safe, they're going to get destroyed. Your bond fund values in a rising rate environment will get destroyed. And so I'm just here to tell you, if that is your safe bucket of money, your bond funds, that may be something that you want to reconsider. At least get educated on how bond values fluctuate with interest rates so that you can feel comfortable with the risk that you're actually taking on.
We're touching on a psychological principle here that is even bigger than just bonds versus stocks versus the three different pillars. Like, it's using yesterday's logic to address today's or tomorrow's issues, problems, is it's a tale as old as time, because we all lived through yesterday, whatever yesterday is for you. And you have a certain set of knowledge and understanding and wisdom and experience that comes from living through yesterday. And every one of us, I don't care who you are, assumes that the information that I have, that I've accumulated during my life, is accurate because I was there.
You attached meaning to it.
Yes, you attach meaning to it because you have life experience. And so it's just natural human nature to say, and I'm going to use this wealth of knowledge to make decisions for today and for tomorrow. And using yesterday's information to solve tomorrow's problems is a major failure in the portfolio management, retirement planning, income planning reality, because things change so fast. And really, the environment that you're retiring into is the backdrop, the context is so important to consider with that information. We have this example that we do, and I'll try to do it justice here when I can't show you the visual, but it's kind of this hypothetical example of these two brothers. And we show their portfolios side by side. And one of them retires in 1990, and his first 10 years of retirement are the 90s. One of them retires in the year 2000, and his first 10 years of retirement is 2000 through 2010. We show the exact same amount in their portfolio. They each have the same amount of money, and they're each invested the exact same way. No difference. But the one who retired in 1990 ended up having millions and millions of dollars more than his brother who retired in 2000, not because of savvier investing, not because of he had more or better information. No, simply the reality of how the returns or when the returns came in. Were the big returns early in the first 10 years? Were they late in the first 10 years? So that example I bring up only to really reiterate the fact of it doesn't matter how creative you are. Whatever information that you're using, if it's from yesterday and you're assuming and implying that to tomorrow, it may not work out that way at all. And so to have a portfolio that encompasses both, that has some liquidity, has growth, has safety, and is getting that from the right sources is the only way to sort of mitigate that reality.
So we've talked about the liquidity bucket, we've talked about the growth bucket, but we haven't actually, we used real estate, but the truth is most people come into the office, and if they do own real estate, they're like, I'm looking to divest of this real estate. Right. I don't want to be a landlord anymore. Some people love it. A lot of people don't. And so they're looking to actually get rid of that portion of their portfolio once they do get into retirement. And so then they need a new safety bucket. So the one thing that checks that safety box that everyone seems to hate for no real good reason would be annuities.
Matt, let's define safety real quick.
Yeah.
Because in our world, to have safe money, it needs to have two characteristics that are both existent at the same time. Number one is it can't go backwards.
Can't go backwards.
Right? Floor of zero. If your money can lose 13% like the bond market did in 2022, newsflash, it's not safe.
So cash.
Okay. Great example. Cash fits the first one. But the second characteristic that must be present is it has to at least have the opportunity to beat inflation.
So not cash.
Correct. Not cash. More years than not, it will beat inflation. Maybe not every single year. Let's be realistic. So can't go backwards, has the upside to possibly beat inflation. And so when we say safety, those two things are important. And so, cash, not probably going to work. CDs, not going to work. Bonds, not going to work. Money market fund, not going to work. And so what does fit in that box? There's only a few things.
I would say annuities fit in that box. Mm-hmm. Some money market funds can fit in that box.
Sure.
But conceptually speaking, I hate it when people come into our office Let's say we got the two brothers. Let's say brother number one comes in and says, Matt, I want you to manage my money and I want you to get me a 20% rate of return every single year. My response is going to be, all right, like we can shoot for that. Like, sure, we can shoot for a 20% rate of return. Our management fee is going to be, I don't know, let's just say it's 1.5%. It doesn't matter what it is. It's 1.5%. We're going to charge you 1.5% a year to get you 20%. And he's like, great, I love it. Sign. And then brother number two comes in. Matt, I want you to get me a 5% rate of return. I just can't stomach the risk. I know my brother's a high flying, like he loves the risk and he loves the 20. I can't do that. Get me a 5% rate of return. I'm going to say, okay, great. Our management fee is 1.5%. That doesn't make sense to me. Mm-hmm. I'm going to charge you the same fee, whether I'm shooting for a 20% rate of return or whether I'm shooting for a 5% rate of return. That doesn't make sense. When you go to the car lot and you're like, I'm deciding between the McLaren and the minivan. And somehow they're the same price. Yeah. I guess I'll take the fast one. Like that doesn't work, right? We know this inherently. We all live in this world and we all know the expensive things are expensive for a reason. But that's not how our world works. That's not how the investment world works. You want a 20% rate of return or a 5% rate of return, my management fee is the same. And
our costs are the same.
Our costs are the same. I don't like that. It's hard for me to feel like we're doing a good job when we're shooting for a 5% rate of return and our fees eating up a fourth of it. Like that's crazy. If you want us to sit down with you and double check the portfolio that you have, show you what real polarity would look like, make sure that you have all three of those pillars, growth, safety, and liquidity checked for your retirement plan, give us a call, 770-741-0120. You'll sit down with us and the team. We'll talk about you, your goals, who you are, where you're going, and figure out if we can help you or not.
Insurance products are offered through the Insurance Business Advanced Planning Group. Vincent Financial Group is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Advanced Planning Group are not subject to investment advisor requirements. Advanced Planning Group and IPW are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be constructed as advice designed to meet the particular needs of an individual situation. Vincent Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained by sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Vincent Financial Group. This podcast is a paid placement.